Hey, what's going on, guys? So this is going to be part 2 of the basics to ICT. I made a part 1 video, but I'm kind of going to remake the video. I am a little bit more organized than I was in the last video. So if you guys don't know what ICT is, I felt like this would be a good time to make it because it's the new year, and I know people like learning new stuff. It might be like a New Year's resolution to get into trading more this year. So again, this is going to be a video that goes over all the basics of ICT and what you need to know and what you don't need to know. So basically what ICT is if you type in ICT 2022 mentorship, it's this guy, it's called Inner Circle Trader on YouTube, and he teaches how the market moves in a way that is very different from a lot of people. He uses no indicators. It's smart money concept. So he teaches in a way that's very precise. He teaches with precision. And it's, again, probably one of the best things you could probably learn right now. It's really precise. I've used it and it's totally changed my trading. So I'm kind of gonna go over the basics of it. So the two things that with ICT are the entries. Okay, so there's gonna be two types of entries, and it's gonna be off a fair value gap or an order block. So basically what a fair value gap is it's gonna be I'm gonna draw an example of some candlesticks here to show you a representation of what a fair value gap is. So you guys can kind of see this. So it's gonna be part of a 3 candle formation setup. It doesn't always have to be 3; it could be more than 3, but you'll kind of understand what I mean in a second. So in this picture, what do you see? So basically, you have these wicks. And in this middle candle, do you see how this wick and this wick, they don't overlap? So the low of this candle does not overlap the high of this candle. So you can see it makes this gap from this high to this low. So it kind of makes this gap here. And what does this mean? Well, this is a bunch of big sellers in this candle, within this candle, to kind of re-put price back down. And a lot of people are like, well, that's supply. Well, not really, because supply is usually at top and bottoms. This could be in the middle of the trend. It could be at the top of the trend. This can be anywhere inside a trend. Okay, it could be at the 0.50 retracement. It could be at the 0.3 retracement. It could be anywhere. Okay, so you kind of got this fair value gap with this wick, and it's same thing goes for the opposite side. So the opposite side, if we have 3 bullish candles, just flip this around, and this it would be a bullish fair value gap. So in this example, this is a bearish fair value gap. And you can kind of see I drew from this wick to this wick. So let me just draw some examples. So in this situation, do you see how this wick does not overlap this wick? This would be a bearish fair value gap. Okay, so I'm drawing it from this wick to this wick. It doesn't overlap. Okay, look at this candle. This wick right here, if I draw it to this, it overlaps this high. So this low, this candle overlaps this high, this candle. So the first candle's low overlaps the third candle's high. So there would be no fair value gap, okay? Because in this one it doesn't overlap, and this one it does. So another one would be like right here, which I did alert this short in my premium that I do in my Discord channel, which obviously the entry has not been hit, but I did alert this short to short here. This is also another fair value gap right here, okay? And you can see we rejected it, but the better entry would have been here, which is where I alerted in my Discord. So this is what a fair value gap is. I'll show you a bullish. So a bullish fair value gap would be something like this right here. So from this wick to this down here, this is a bullish fair value gap. So that's kind of the basics of fair value gap, and this is probably going to be your main types of entry that you're going to want to know when learning ICT. So this is kind of the number 1 thing, and then number 2 is order block. So basically what an order block is it's not necessarily, so a lot of people say it's the like up candle or down candle before like the opposite. So it's the true definition of an order block is, I'll say this, is a change of price delivery. Okay, so it's a change of delivery and price. Basically what that means is, see how you get this green candle, then this giant dump? This green candle would be an order block, and some people know this is supply zones, but this is in the order block in ICT terms. And what makes this, and obviously this is a green candle, but this would be a bearish order block. So let me show you a good example in the 15-minute. So in the 15-minute, we had this green candle up before this giant down move. And this is kind of how smart money moves the market. So what they do is institutions bank, they enter a position here and they kind of get the market go up, but they know it's coming back down. So what they do is they get in and out at break even at this order block, and it kind of helps them move the market up and down a little bit. And obviously it's much more advanced than this. I've watched a couple of videos on this, but it's kind of that idea that smart money is in this, and it's illegal for smart money not to show manipulation in this market. So this is one of the ways you can kind of see smart money manipulating the market when we get the green candle before this down move. And there's parts of an order block. So the best spot to take an order block is off like the opening of the candle. So you can see we never actually hit the entry here, but this would be not bad short entry because it's the opening of the candle. And ideally this green candle and this would be the whole order block. And sometimes you're going to get something where there's like a couple of green candles in a row before a giant dump, so that would be the bearish order block. But like in this example, look, boom, you get the rejection off the opening of this candle, okay? And there's also the 50% part of the candle. So once it gets to like the 50%, which would be right here, not counting the wicks, I think you draw from here to here. Once you get to that 50% level, this is the level you really want to see it to hold. If it goes above the 50%, that's not a bad spot to get out. But I've seen order blocks where if you have your stop above the order block, sometimes we'll go all the way up to here, then we'll dump and we'll go past 50% retracement. So the 50% retracement of the order block is you really want to see that hold. But again, I usually enter off the opening of the order block, so I would enter off here, and as you can see, this obviously successfully worked right here. So that's kind of an order block entry. Again, right here is another order block. And the reason why I like this one is because you get a red candle and then a green candle and then another red candle. If you had a green, that would kind of not really be, it would be a really messy order block. It would just kind of be a big order block. So it would be like right here to right here versus there's only one single order block right here, okay? And you can see we do reject the fair value gap here. And the thing with fair value gaps is fair value gaps are kind of more common entry and more I believe they are better entries than order blocks, because some order blocks are kind of hard to kind of find if you're not looking in hindsight. So this was an order block I actually noticed without looking in hindsight, and I didn't short it because it was lunchtime, but based off ICT strategy, there's obviously more to this being just an order block to short, but I was bearish, and I was expecting a rejection of this order block. But for sometimes in hindsight, like let's say like right here, this is a bullish order block, so this red candle before it's up move, this is a bullish order block. I expected that, but there's order blocks where in hindsight I'm like, oh, I wouldn't have noticed that in real time, okay? Because some of these order blocks can be a little like messy. So some people like on Twitter, they'll be like, well, this is an order block or this, and some people argue it is. So these clean order blocks, which are more rare, I like the best, like where we get like a red candle, then green, then red. I like those the best. But again, I prefer fair value gaps for entries. Another thing you can do is watch for like a higher time frame order block. Like if we are at right here and you're watching for this 15-minute bounce, what you can do is if you see we are starting to respect this 15-minute order block, what you can do is go on the 1-minute time frame at this level and then look for like a long fair value gap to enter off of. So that's another thing you can kind of do. So those are the main things about fair value gaps and order blocks. Another thing I will say with fair value gaps is you want to see the candle not close above the fair value gap. Sometimes it does and we still reject, but it's better to see, like you can see this wick clearly went up, but after this 15-minute close, you would expect to dump here. Why? Because this is the 9:30 candle, and you can see we go up 10 points, which is basically $10. So we go up from 3890 to 3900, and you can see the candle close inside the fair value gap still after this massive rejection of this wick. So again, that'd be a good confirmation to shorten this fair value gap rather than just kind of shorting right in this fair value gap, because Some people, they'll be, oh, I'm gonna short as soon as it hits the fair value gap, but this is kind of better confirmation to wait. It's all up to your preference. If you're in the 1 minute, a lot of times you're gonna slap it. So what does that mean? That just means let me find an example real quick. So we never actually ever hit those, but like right here, some people just slap it as soon as you wake into the fair value gap, because sometimes you'll see something like this where we don't dig that much deeper into the fair value gap. So yeah, so those are the kind of two basics on fair value gaps and order blocks. There's more to that, but again, this is going to be a pretty basic video. So how do you use these order blocks and fair value gaps to decide where price is going? Well, that's where liquidity comes in. So liquidity is kind of like support and resistance. So some of you might be like, oh, this is support. Okay, so you see these two lows, we bounced at these two lows, so this would be support. Well, in ICT, this is liquidity. So once you're short, once you see kind of bearish structure, this would be your target. And usually what happens is if we don't bounce off this, we usually go through it, and then your sell limit is right here, okay? Or your cover limit if you're short is right there. So that finding a liquidity is very important. For liquidity, I really like the equal highs and equal lows. So that's kind of a double top or double bottom in retail terms. So an example of last night is in my Discord. I'm gonna show you guys real quick. So basically yesterday in my Discord, I said this. Okay, I said watching for long setups tomorrow if these equal highs remain. So you can see I have this giant red line, and this looks like resistance, but this is not resistance. This is where the market algorithmically creates these highs so we can run through them. Why? Because a lot of retail traders are like, oh, this is resistance, we're going to reject from them. And what happens is we go above them, we stop all them out, then we reverse. So you can see that I kind of drew these equal highs at 6:49 p.m. last night, okay, and I drew them on the 1 hour. If I go to the 1 hour, I'll kind of show you, but you can see right here there's clear equal highs. These are almost perfect equal highs. So why would the market algorithmically reject the same exact spot 3 times? Again, it makes no sense. So it does it because it wants retail traders to short off this, so it creates liquidity to go up and reverse, okay? And usually you need liquidity to reverse. So like in this situation, you can see as soon as we hit this low right here, look, we go right under this low and then we bounce, okay? And some of you might be like, well, no, that's support. Well, I'm telling you that is not support. It's just us stopping out these people who are long, and then as soon as we stop them out, we reverse, okay? And if I was short, my next target would probably be these lows down here, because there's going to be more people stop loss below those lows. But what happens is once we hit these like intermediate lows, what happens is we reverse a little bit, we go up, and then we keep dumping. So what does this do? It stops out the longs, and it also stops out people who try shorting, because people, as soon as you see these people, like as soon as you break this low, people are going to be like, oh, I'm going to try shorting. So they try shorting, and look, they get wrecked. And then we start going back down again, and they're like, oh, I got stopped out, and then it reversed on me. So that's kind of how ICT is. It kind of teaches you how the market moves, and it's smart money concepts. So these are very important to understand. So your 2 entries are going to be off of fair value gaps and order blocks. And with those entries, you need to be looking at structure. So if you guys don't know market structure, I'll definitely watch a video on that. But basically, this would be an uptrend where you're creating higher highs and higher lows. And again, vice versa for kind of the other way. So if I flip these around, which I don't even know if I can flip these around, it's whatever, but that would be an uptrend. This would be a downtrend like this. So you can see in this example, we got a lower high and lower lows. So lower high, lower low, lower low. So that would be downtrend. And to take these fair value gaps, you need to break a market structure shift, or you need a market structure shift. So what does this mean? Well, if we're in an uptrend, you can see like right here, we get a higher low, higher low, higher low, higher low, higher low, and then boom, what happens? We break this last higher low, okay, like right here. So this would be your market structure shift, which is what MSS stands for. And then that's when you look for a retracement to a fair value gap. So in this situation, you can see, boom, we have a fair value gap here. We got a market structure shift. And you want to make sure this is an energetic shift. So we get this energetic shift down. It looks like a strong move down on its low. And again, right here, you never get your entry. Sometimes that's going to happen where you don't get your short entry, but this would be a great spot to short. And a lot of people wonder, well, next time it comes back up, would you short? Well, no, because it has to be within like the shift of market structure. So this is like after a whole new trend up here. So sometimes they do work, but again, the best spot is going to be right in the trend after the market structure shift happens. So we get the market structure shift, and then boom, you want to see a retracement. And we don't get in there, but then what happens? We create a giant 15-minute fair value gap, okay? We still have this fair value gap right here, and you can see that we never close above it. We just kind of wick through it a little bit, and we have this fair value gap right here. So this is the highest possible fair value gap, okay? And I really like taking the most bottom or most top fair value gaps, and in this situation, look what happens. We create these equal highs right here, right below this fair value gap. So this is kind of your liquidity where people are like, oh, it's a double top, go short. But then we stop at the double top, and then we just totally reject from it. And at the same time, we're still in this giant 15-minute fair value gap, which we never close above. As soon as you see this wick, you can enter here, like without confirmation, or this after this candle close, after you see it doesn't close above, this would be your confirmation to go short. And you can see we just dumped from that. Here's another fair value gap we just never hit. But this would have been a very good fair value gap to take. Why? Because we have our market structure shift here. We dump through this low. Trend of trend, we have a higher low, higher low, higher low, higher low. And we just totally dump through it. And what I just showed you is this is a kind of a break at higher low in the 15-minute. But sometimes you can catch these moves pretty early if you see a smaller structure break in the smaller time frame. Like this is the 3-minute. But this can be risky at times because sometimes it's inducement. And I'm not going to go over inducement in this video. I've gone over it in a couple of my other videos. But basically inducement is kind of like we go over highs inside a fair value gap. And then we stop out these people, but we still reject. So this is kind of inducing these guys, which means we stop them out and then we reject. And you can also see like we bounce out of this fair value gap to the long side. We never close above. We never close below it again. We bounce off that, but at this time, the structure was bearish on the smaller time frame, which is why we kept dumping. So you can kind of see how that works. So this is kind of the basics for now. If you guys have any questions, let me know. My Discord link will be in the description. If you do have any questions, I do have a premium, but if you guys are new at ICT, I wouldn't suggest joining yet because some of my alerts can be confusing. But it's a good spot to talk about this stuff. But yeah, other than that, I hope you guys enjoyed. So the main things I want you to take from this video is fair value gap entries, order block entries, and kind of the market structure and looking for these entries. There's more stuff to base your entries off of, like discount or premium, and I can go over that quickly. So basically what discount or premium is you draw the 0.5 fib, and you draw it from like a swing high to swing low. So like let me delete all this, and you draw it from like the nearest leg, swing high and swing low. So like on the 15-minute, you draw from this high to this low because those are the most obvious. And basically premium would be above the 0.5, and you want to short always on premium, and you want to long and discount. So you can see as soon as you hit premium, you want to short. And when prices are high and you go to the store, you don't want to buy them. But you don't sell them either. But in the market, in terms of the market, you want to short them. So this is why you short in premium. And when things are in discount, you can see like from here to here. When things are in discount, you want to long. You want to buy them. So when this hits discount under the 0.5 fib, that's when you look to buy. A lot of times, what you want to do is you want to look for a fair value gap that's under the 0.5 to buy. It's not good. Like you can see in this situation right here, this fair value gap is over the 0.5, so you wouldn't long that fair value gap because it's over the 0.5. It's just not a good long because the price is still too high. So you want to wait till it retraces into discount, and you can see in this situation it does retrace to discount, and it does bounce. It doesn't end up hitting the highs, but NQ did in this situation. So there's ES and NQ. NQ is just QQQ. ES is just SPY. So this is basically SPY but times 10. So yeah, that's kind of discount and premium for you. Want a long and discount, which is under the 0.5, short and premium, which is over the 0.5. So that's kind of how that works. So other than that, I hope you guys enjoyed. Let me know if you have any questions in my Discord. And other than that, peace out.